Hello, this is Rick Komarek, Certified Financial Planner, and I want to bring you a brand new article that I just loaded to my blog today, March 17th, titled, "This is not the 2008-2009 financial crisis." The 08-09 financial crisis came from systemic bad practices within the financial system, and today our banks are solid, and the current situation is a result of an acute health crisis, which, however dire, will pass. The financial crisis was a period of great uncertainty as well, but where both the short-term and the long-term behavior of the market and the economy were complete mysteries and required systematic changes for years afterwards. While the immediate future is relatively uncertain, it is fairly certain that within the next 3 to 6 months, the situation will resolve itself with the current situation. Uncertainty caused by new cases and no clear path forward have created market volatility. The current market distress is most directly related to the uncertainty surrounding the future of the coronavirus. The best source of current information that we have is from Johns Hopkins, which provides an interactive world map. Below is a picture of the map with the current cases in the US, and each circle represents a particular state, so you can take a look at that. In regards to the current number of confirmed cases, there has been an increase over the past week. This could be in part due to the increase in testing. It's also quite difficult to predict how the virus will fare in the next several months. There are multiple unknowns, such as how the virus responds to increased temperatures and whether people who have survived the virus can contract it a second time. Again, these known unknowns will continue to create market volatility. Uncertainty yields risk, which yields market volatility. Investors are largely responding to headlines. Instead of calmly determining the long-term risk of the current situation, investors are basing their trades on emotions instead of the numbers. This has caused significant market volatility over the past weeks, as each day brings different news from the day before. This graph shows the market has been experiencing significant gains and losses with seemingly no rhyme or reason. Just last week, the Dow closed down 9.99% on one day. Then Friday, the same week, the Dow also had one of its largest point gains ever, rising 9.3 in the last 30 minutes of trading. Then on Monday, March 16th, there was a 12.93% decrease, which was the second worst daily drop. So here's the chart showing those up, down on a daily basis so far here today. Coronavirus has affected businesses, and a technical recession may be coming. We may be headed into a recession, but it is likely that any recession we have could be short-lived. January and February numbers were sound, and the banking system is also fundamentally sound, unlike in 08. As a result, the data is showing that Q3 and Q4 will still emerge as a positive quarters, and remember that stocks typically rise before a recovery. Don't sit it out, however tempting that may be. The golden rule of investing is to buy low and sell high. In theory, this strategy is fairly simple. Purchase at low prices and sell at high prices. Unfortunately, implementing the strategy is much more complicated because emotions and timing issues come into play. Attempting to time the market by selling off at a potential 30% loss can cause you to miss out on the market's best days, which can account for much of the market gains. Looking back at the past 20 years, an investor who remained invested for the entire period would have accumulated, and I believe they started with 100,000, they would have accumulated 324,000, while an investor who missed just 5 of the top performing days during that period would have accumulated only 214,000. So that's nearly 1/3 of all the returns were found in those 5 days. So it shows the importance of not missing out on those days. And we don't know when those days will be. The rebound will be coming before you know it. While the coronavirus has sent us into a bear market, it is important to remember that typically the market rebounds from epidemics quite quickly, particularly when, as here, the underlying fundamentals are strong to begin with. From the table below, we can see that despite any poor performance that initially occurred following outbreaks, stocks managed to experience gains typically within 1 year and sometimes sooner. So you can see this chart with the SARS, the bird flu, the H1N1 swine flu, Ebola, and most recently the Zika virus, and the returns that occurred shortly thereafter. So the conclusion of the matter is this is not the 08-09 financial crisis or anything close to it. The current fear of the markets is unknown, but it's not structural instability. A recession is not guaranteed, but if one does occur, it should be short and nowhere near as damaging as the 08-09 financial crisis. Lastly, remember not to get caught up in the immediate, but instead think long term, and this too shall pass. If you have any questions about your investment, your account, retirement, financial planning, feel free to reach out to me anytime.